Good morning. It's Jeffrey Christian of CPM Group. It's 10:25 in the morning here in New York on Tuesday, August 26th. I want to talk about the economy, the state of the economy, and the precious metals markets. I'll also talk a little bit about overseas holdings of U.S. Treasury securities, give you some data on that. And then I'll talk about Saudi silver. There's been talk about the Saudi central bank buying silver. It's not exactly accurate. And there have been pundits on the internet who have acted as if this is fabulously unique and new. I will point out that Nelson Bunker Hunt was in Saudi Arabia discussing and trying to convince the Saudi royal family members that he knew to buy a silver-backed bonds in early 1980, the day that he failed to meet margin requirements and his position was liquidated, cutting the price of silver in half that day. So the idea that the Saudi royal family has newly found an interest in silver is not exactly accurate. 45 years ago, they already were big time interested in physical silver as well as other silver assets. But we'll get back to that at the end of this video. These are CPM Group's economic projections for the next 10 years, real GDP. The red line is on a global basis. The dark blue line below it is industrialized nations or advanced economies, as some groups call them. And the blue line above that is the emerging and developing economies, which tend to have higher growth because they're coming from a smaller base. And in many of those economies, they have more dynamic economic environments right now. We have been wrestling with our long-term projections. These projections basically predate the Trump administration and the policies it has been initiating and pursuing both domestically and internationally. We had expected and projected a severe recession in 2025, 2026 for several years, really since about 2021. We've been saying that we thought that this could happen. And importantly, you can see the post-recession recovery that we're projecting takes global economies and regional economies back to lower levels in the post-recession recovery period than were the case for most of the period since the 1980s. So we're looking at an economic environment. Now, over the last 8 months, we have been wrestling with this and what do all of the policy changes and the deterioration in international cooperation mean for the global economy. And we actually have kept our projections largely intact during this time. There are all kinds of data points and arguments to say that the rise of tariffs, the reduction of immigrant labor availability in the United States, and a variety of other factors, the firing of a significant number of not only government employees, but also people who were employed in companies that and research facilities and development facilities that provide services to the U.S. government, that all of that could exacerbate an incoming recession and make it worse. There's also data that shows that over the last several months, the economies have been more resilient to these factors as it is. We've pointed out repeatedly that you have to wait to see the effects, some of the effects are immediate, and we are seeing negative effects economically, not only in the United States, but in other countries from these policies. But the most of the effects will take months and quarters to evolve. In addition to that, if you look at the big, beautiful budget bill, a lot of the most severe cuts to health services, educational services, road transportation, distributions of money to state and local governments. A lot of those uh, passages that have been in passed into law are not scheduled to take effect until after the 2026 congressional elections. The Congress people who voted to slash these government payments and spending know that if they had allowed that to take effect before the 2026 elections, they probably wouldn't have jobs. So a lot of those things don't kick in until late 2026. Bottom line is we continue to look at the U.S. and global economies, and we see difficult times ahead. I put this title, this quote up here. I heard this morning. The windows on truth are closing. That makes it that much more difficult. But we're data driven. We're not demagogues. We're not ideologues. We don't believe in the right or the left. We look at data. And the problem is that the data is beginning to be distorted. And even if the data is not as distorted as some people would like it to become, it doesn't matter because increasingly the voting public and the consuming public and government and corporate leadership don't look at data. They look at feelings and emotions and beliefs. So it's really kind of difficult. I'll stop there because we could go on for a long period of time, but the bottom line is we have tremendous uncertainty. We have extraordinary risks in the economies, not only in the United States, but on a global basis. And there are political problems, both domestic and internationally, spread around the world, all of which should be expected to continue to keep investors worldwide worried, concerned, and perplexed by where we're going. Chairman Powell of the Fed gave a very accurate reading of the state of uncertainty in economic developments at the Jackson Hole conference last Friday. Gold prices were around, the spot price in New York was $3,380 a half hour ago. The active COMEX contract that we look at and that we chart here was 3,420. So the active contract was over 3,400 as it has been for a couple of days. It's trying to break above that. And we've said that we thought it would break above that and possibly rise to 3,500 yet in August. That may not happen. And we said that 3,500 or even 3,600 was possible over the course of September and October with higher prices later still. And that reflects our view that the economic uncertainties are going to continue to incentivize investors to move a portion of their wealth into gold and silver. And we continue to see that on a global basis. Silver prices, $38.51. They have been trading, between $37 and $39 over the last several days. Our expectation is they will continue to do that. The price of silver may rise a little bit and move toward above 30, more forcefully above $3,900. That seems to be the trend. And then, as with gold, we expect higher silver prices in September, October, November, and into and through 2026. Again, reflecting that stronger investment demand. It hasn't been as dynamic as gold because silver is not as universally seen as an investment as gold. And B, you've had more investors taking profits and selling their silver at these higher prices above $35 an ounce than you have seen investors selling their gold at prices above 3,000. Platinum prices have continued to come down. Our expectation is that you've seen the first leg of the decompression. You saw the price rise very strongly during June and the first half of July. The price came down a portion of the way, about a third of the way, and we've seen some consolidation around there. Our expectation is that the price will make another leg down and move back toward that trading range that we saw earlier. We have been saying, several years ago, we were saying that we thought that the trading range may move upward from 800 to 1100 to a newer range of 900 to 1200. That still seems possible, or it seems possible again. But the platinum price does not seem likely to continue to rise strongly as it had over those 6-week period of time. And the palladium price also has continued to decompress and give up larger portions of its upward spike in June and early July. The price is 1,093 this morning. It's back into that range that we've seen since late 2023 of, say, $900 to $1,200 or $1,100 an ounce. I want to show you some data now on the world's holdings of U.S. Treasuries. Total overseas holdings are up about 10% as of the end of June compared to where they were at the end of June 2024. And foreign official holdings are up 2.3%. Let's see if I can do this easily. This is a table from a monthly Treasury report, and it is major foreign holdings of U.S. Treasury securities. And again, it's interesting because in some places the Treasury accurately talks about these are overseas holdings. These are foreign and international investors. And some portion of this, a large portion of this, appears to be U.S. pension funds, corporations, and wealthy individuals holding wealth offshore to reduce their tax burden in the United States. And they hold those offshore assets in U.S. Treasuries so that they don't have a currency risk. Their offshore holdings of these treasuries are denominated in U.S. dollars. And the U.S. dollar, as you know, has been very strong over the last 20 years. It's off maybe 7% from the beginning of this year, but it's up like 40% from where it was in 2011. And probably more than 10% from where it was in 2021. So there's some portion of this that's unknown that's held by the U.S. entities. But I want to show you, because you hear a lot of gobbledygook about this. Japanese groups are the largest holders of U.S. Treasuries offshore. And this data does not discriminate and allow to identify individual investors holding these or between the government and others. Let me zip down to the bottom so that you can see. At the bottom, there's a grand total. And you have like $9.1 trillion of Treasury holdings at the end of June. And that was up from $8.3 trillion at the end of June. That's a 10% increase, excuse me, but yes, that's a 10% increase in a year. And that 8.2 was actually a record amount last June. So the amount of Treasury holdings offshore have risen 10% in the last year, but they had risen another 15 or 20% in the prior 2 years. So collectively, overseas holdings of treasuries are not being dumped. Now, the Treasury can break that down and say this much is held by official entities. And that's the next line down. It's $3.9 trillion, which is up from $3.8 trillion a year ago. That's a 2.3% increase. And then you can break it down between foreign official holdings of Treasury bills and foreign official holdings of Treasury bonds. And you can see that the bonds have actually decreased while the bills have increased. And that reflects expectations, well, higher interest rates on the short term, and expectations that the bond yields will have to rise later, but they're unattractive right now. So the official holders are playing the yield curve. But let's go back up to the top there. The largest holders are collectively people in Japan. And again, that is up 5% from a year ago, as of the end of June. The United Kingdom has the second largest holders, $858 billion. That was up 15% from a year ago. So a big surge in people saying, I'm really worried about the world. And one of the things I'm going to do is buy U.S. Treasuries because they are seen as less risky than other sovereign debt and corporate debt. China is actually off 3%, but China, as many of you probably have heard, has been having a lot of domestic economic weakness, and it has actually been using its foreign exchange reserves to help support economic activity within China. And most of its foreign exchange reserves are actually held in U.S. Treasuries. So the fact that it has sold off or used 3% of its treasuries over the last year does not necessarily suggest dissatisfaction with holding U.S. Treasuries. It reflects the fact that they're using their monetary reserves for what those monetary reserves are intended to be used for, which is to help support the Chinese economy and keep it out of recession. And it's interesting because you can go through that. Those are the three biggest holders, Canada and Belgium and Luxembourg have a lot too. And again, those are a lot of international investment firms in Belgium, Luxembourg, and Switzerland. You see that Russia is not on the list. Russia has had a policy of avoiding U.S. dollar-denominated investments for well over a decade. But the bottom line is you've got a 10% increase on top of previous annual increases in U.S. treasuries held overseas by overseas entities, including governments on a collective basis. So no need to worry there. Finally, I wanted to talk about the Saudi silver. We've been hearing, the Saudi central bank has been buying silver. Well, it's not exactly true. The Saudi Arabian Monetary Authority, which also goes under the name of the Saudi Central Bank, did not buy silver. It bought 932,000 shares in the SIL silver ETF, which is not redeemable into silver. If you want to buy silver, you have to sell your shares of the silver ETF to somebody who is a broker in equities, and then you have to buy physical silver from someone who's a broker or trader in physical silver. It bought silver ETF shares, and it bought 203,700 shares in Global X Silver Miners ETF. These are investments. They're not monetary reserves. The SAMA may not use silver as a reserve asset for monetary reserve purposes because internationally it and other central banks have agreed that silver is not a legitimate monetary reserve. It's too small and illiquid of a market. SAMA bought this silver ETFs, both of them, for a Saudi investment fund, which it manages. Right? Remember, well, I started with that anecdote. CPM Group helped sell entities within Saudi Arabia 50 million ounces of silver in the early aughties, between 2000 and, say, 2002. It was surprising to a lot of people that they saw all of this silver going into Saudi Arabia. And I won't tell you where the silver was sourced, but we had put this program together, and we were helping refineries, base metals refineries, sell the byproduct gold and silver that they were generating from their base metals concentrates that they were smelting and refining. And 50 million ounces went into Saudi Arabia. The reality is that the Saudi investors, the royal family and other wealthy people in Saudi Arabia, have always, for centuries, invested in silver. And it's not new that they invest in silver. They also invest in gold. And sometimes the Saudi royal family adjusts its position. You may remember that, I think it was back in 2008, the SAMA, the Saudi Arabian Monetary Authority, or Saudi Central Bank, if that's what you want to call it, added 5.8 million ounces of gold to its monetary reserves. You can do that with gold because gold's a monetary reserve. Silver's not. And people thought, well, that's weird because we didn't see any gold being shipped into Saudi Arabia or bought. And the reality is that this was gold that was transferred from Saudi royal family investment holdings to the government central bank. You could do that when you're a potentate. That's all I have for now. Take care of yourself. Take care of those around you. Try to do something good for the world. We'll be back on Monday and hopefully, or Friday, and we will hopefully be able to talk about some substantive aspects of the global economy and the global precious metals markets. You can go to our website. You may buy our gold, silver, platinum yearbooks, subscribe to our precious metals advisory, and send us a note at info@cpmgroup.com saying, hey, I want to talk to you about ways that you can help me better manage my exposure to precious metals and commodities. In the meantime, take care and be good.